If you live in Europe and have questions about investing, chances are I will answer them in this video. As an investment trainer, I do live Q&A calls with my students in 34 European countries. I use my 19 years of investment experience to answer questions about ETFs, index funds, brokerages, taxes, and much more. Until now, the recordings have only been available to my paid students. But in this video, for the first time ever, I've compiled a few of the top questions that I believe every investor needs to understand. If I'm in the position of investing a large amount, shouldn't I wait for this mess to calm down? So I've been running this program for 5 years, and I've been teaching investors for around 10 years. And over this period, not just every year, but literally every month, I have had this same question. Now, of course, sometimes the answer will turn out to be, yes, it would have been smart to wait a little because the market drops and then you could invest cheaper. But the problem is no one knows when that will be. I take the approach that I will never do that. I will simply invest when I have cash available and stay with it. I just make sure I have my safety cushion and everything else. Do you have any recommendations about where to keep the cushion money? I think the easiest is to have a high yield savings account at a bank. Right now, you should be able to find an account that pays you like 2% per year, roughly, if it's in euros. So that's what I would do as long as it's less than 100,000 euros per bank. Can I completely ignore news to stay calm about my investment account balance? For passive investors, it's probably more than enough to check to look at the news like once a month. As a practical matter, like there's certainly no reason to check your investment account every day. I have no idea what like today, what is the exact position of my portfolio. I don't check it on a daily basis because it just messes with your head and it doesn't help in any way. For someone starting now, should I adopt a different strategy in order to avoid a possible loss, which will take many years to be recovered? The strategy really should be based on your time horizon and risk tolerance, not based on what's happening in the news. So if you are super, super worried about having a big loss, which takes many years to recover, that's maybe an indication that your risk tolerance is not so high. So maybe you shouldn't have a 100% stock strategy, not today and not 5 years from now. If you were to start building an investment portfolio at the age of 40, what will your realistic split be across all kinds of investment securities? Stocks, bonds, ETFs, index funds, etc. ETFs and index funds are a way to invest in stocks and bonds. So these are not different asset categories. And in my professional opinion, for most amateurs, ETFs and index funds are the best way to invest in stocks and bonds because buying stocks and bonds directly is difficult and most people end up screwing it up and not getting good results. Unless you have a relatively lower risk tolerance, I would be all in stocks in a diversified stock portfolio. And then over time, I would add some lower risk investments like bond ETFs. I'm wondering whether it could make sense to invest gradually rather than going in all at once. The general principles about dollar cost averaging versus lump sum are based on decades and decades of market data, which have included all kinds of volatile periods. So from a financial perspective, like if I have a lump sum, I'm going to invest it all today instead of splitting it into pieces. And now psychologically, if it's really difficult, then I always say, go ahead and split it into a few pieces if it's easier for you. But from a financial perspective, investing a lump sum in one go is still the smartest decision. Is investing in gold better and safer than stocks? Maybe it was somebody else, but I think it was Warren Buffett who basically said, look, if you had a choice for 100 years, you're gonna put all your money and buy some gold, like a chunk of metal that's gonna sit on the shelf. Or for 100 years, your money is gonna be invested in, like, let's say 500 of the biggest American companies where people are gonna go to work for 100 years to try and innovate and create products and make money and help their clients and create dividends and income. Like, which would you choose? I'm not talking specifically about American stocks, but the point is gold is a chunk of metal. So over the really long term, it does not create economic value. And that's why over the really long term, it has underperformed stocks significantly. It can make sense, like some small portion of your portfolio, whether it's gold or silver, just for like diversification reasons. I don't do it. Some people do it. I think it can make sense. In a financial crisis, at which percent should we sell to reinvest later? So I would really recommend, like, I don't know if you watch the whole program, but so we teach passive investing. What you're talking about is market timing. It doesn't work. Like, there is no good way that you can sell in the middle of the market falling and then buy at the right moment. It doesn't work like that. Usually when you do that, you end up losing a lot more than if you simply stay calm, stay invested, and you ride it out. And actually you keep investing even when the prices are going down, so you buy stocks cheaper. That is the usual passive investing approach. What is the ideal number of ETFs to hold? How many ETFs do you hold yourself? I know smart, respectable investors who literally have one ETF, and that can be completely fine. I prefer diversification, so I have multiple brokerages, and because I have multiple brokerages, at every brokerage I buy a slightly different ETF from a different provider, so it's a little bit of extra diversification. But then, of course, if you have a more advanced strategy, for example, if you want to put more of a home bias on Europe, then you will need more ETFs in your portfolio so it can get bigger. So there's no single right answer. But I would definitely try to keep it under 10. If you're getting close to 10 ETFs, it's a lot. I think under 5 for most people is smart. 1 to 3 can be completely fine, especially I think for smaller portfolios. Andreas asks, what are the key fundamental metrics we need to look into when evaluating ETF performance and future direction? We don't pick investments based on performance. So the only thing about performance with ETFs that you can do is really check if it is tracking the index correctly. But past performance does not predict the future. So there's never any point where I'm looking like, okay, I'm in a global ETF and I'm checking how were the last 3 years now, should I stay with it or not? Maybe the last 3 years were kind of crap, but that doesn't mean the next 3 years will be good. Or maybe the last 3 years were good. It doesn't mean the next ones will be bad. That's not how we do it. Like we pick a diversified low-cost strategy, and then we just make sure that the fund is tracking the index that it should be tracking. And the things that you want to check is diversification, it's low costs, and it's the technical aspects we look at in week 3 to make sure that it's still good for your tax situation. Konstantinos asked, I would like your opinion about ETFs, Aristocrat dividends. So this is companies that have been increasing dividends for many years in a row. From a financial theory perspective, there's really no good reason to be focusing on dividends. Like, it's not a good way to select the most profitable investments. People have this mental bias where they think when they get a dividend from a stock, they're getting richer because they have more money in their account. It's not true. If a company pays out dividend, now you have money in your account, but the company doesn't have that money in the bank account. So the company becomes less valuable. The stock becomes less valuable. You don't gain anything when the company pays out a dividend, except you have to pay tax on the dividend. There are some other features such as profitability. The companies are profitable in the first place. That can be a good sign for long-term returns. And profitability often comes together with dividends, but specifically focusing on dividends too much usually, like, it's not the smartest move. I'm worried sometimes about Tesla being a big part of the world ETFs with the recent weird situation with Elon. It might reduce the value of the ETF. Yeah, it could, but that's why we are diversified. Yes, it is a notable percentage. But even if, let's say, even if Tesla were to completely fail, they're not going to be the first, they're not going to be the last. I mean, that's part of the history of these broad indexes. That's part of what gave us those good long-term results. Some part of the index will always fail or do badly, and others will do well. So if I had 50% of my portfolio in Tesla, I would be very stressed out. But if I'm invested in like a global stock index, I'm not too concerned. In times of such high uncertainty and volatility, would you consider changing the weights of various ETFs forming your portfolio? When I ran a pension fund, which got the best results in the whole country, one of the reasons we got such good results consistently was that I was not allowed to mess with it. And that taught me an important lesson. There were many times when I was kind of worried about something and thought, okay, maybe it would be good to change. But we had a clear policy and we just could not mess with it. We had a passive approach, and that ended up working so well. And usually, like if you look at decades of history, the passive approach beats most active approaches. So I always keep that in mind. Even if it seems to me like maybe it would be smart, most of the time it's not smart. It just feels smart. Hey, real quick, if you're finding this useful and if you live in Europe and want to start investing, you might benefit from my step-by-step training program, the Index Masterclass. In the program, I take you through everything that you need to know to invest successfully as somebody who lives in Europe. Plus, I'm always on hand to answer your questions. So if that sounds interesting, just follow the first link in the description to find out more. Supposing markets are at all-time highs, would you still invest in ETFs? Well, yes, I would, because the stock market hits all-time highs 16 times a year on average. It is normal for the stock market to hit all-time highs. That is not an indication that something is wrong. It's not an indication that something is bad. The market over time goes up, and in a typical year, it hits all-time highs many times. It's supposed to. How diversified are global ETFs if like 60% of a global stock ETF gets invested in the US market. Okay, yeah, so for a developed world stock ETF, 70% will go in the US. For an all world fund, it's closer to 60% because it also includes emerging markets. How diverse is that? Well, in a sense, it's quite diverse because a lot of the US companies are actually global companies. Many of them make more than 50% of their revenues globally, not in the US, so it's quite diverse. But the other kind of evidence-backed strategy that I see making sense is adding more of a home bias. There are many experts who would say it makes sense to maybe put 30% in your home region. So for us, that would be like European stocks, which reduces the risk that other parts of the world could treat us worse, like if Donald Trump decides to harm foreign investors or something like that. Carolina saying, I just don't see tech going down. I mean, the world will always need tech development. What do you think? That's not how it works. Even if the tech industry does well, it doesn't mean that tech ETFs will do well. If the prices are already high and reflect assumptions of huge growth in the future, and then the actual growth is still good, but not as good as expected, the prices can still go down. So, I mean, sector investing is generally very risky. People tend to jump in when it's hot, when stocks are high, and then they tend to have disappointing results on average. I'm not saying don't do it. I'm just saying that's generally what tends to happen. Fred asked, what is your take on ETFs that are overlapping? Does it happen inevitably, or is it better to avoid it? My big issue with overlapping is if it confuses you and you don't know what you're holding. Like I've seen people, they say like, okay, I have this all world ETF, I have this developed world ETF, then I have this USA ETF, then I have this US socially responsible investing ETF. And like, what are you accomplishing by having all these overlapping funds? You're not even clear what your strategy is. That is what I don't like. Now, in some cases, sure, there's going to be overlap. For example, if you have an all-world ETF, but you decide, I want a bigger emphasis on Europe, you might, in addition, have a European ETF, and they are going to overlap because the all-world ETF has some Europe as well. But you know why you are doing it, because you want more of a home bias. It can be completely fine. Is it better to keep investing in the same ETFs or keep adding new ETFs in the portfolio? Mostly keeping the same is going to keep it simpler, but there can be some benefits to, like, I don't know, every 5 years, maybe you add a different ETF and switch to putting new money into a different ETF for tax reasons. It's one of those things where that gives you more flexibility. You can choose which ETFs do you sell, and then some of them will have a big profit component, some of them will have a small profit component, and so you can sometimes optimize taxes. Also gives you a chance to start putting money into cheaper ETFs because over time new ETFs appear that are cheaper. But I certainly wouldn't do it too often. Like, certainly easily could go for 5 years just using like one ETF or one small set of ETFs and then maybe add something new. If an ETF were to rise very quickly, let's say 20% in a single week, would you typically take some profit or just let the position run? I mean, I invest in broad global ETFs. It's extremely unlikely for a broad global ETF to rise 20%, unless it's like after the 2020 COVID crash when there was a big crash and then relatively quickly it recovered. But even if it happened, I wouldn't do it because I don't time the market. I stay in the market long term. This sounds more like something that could happen to an active trader who made a bet on a particular industry and then it goes up and then you sell it to fix the profit. But for long-term passive investing, it's not really something I would do. As an ETF investor, do you still feel the urge to invest in individual stocks? I do sometimes, and I've done a little bit. I've actually made a couple of startup investments, and then I realized most of them looked like they were going to collapse and I'm not going to make any money. So I played a little, but that experience has reinforced that probably my best bet is staying with index funds and ETFs. If you plan to retire early and then withdraw the 4 to 6% per year after retiring, is it still too risky to do all stocks? Because I don't plan on selling. 4 to 6% per year sounds aggressive. So 4% is kind of the standard safe withdrawal rate that people have been using for a long time. If you look at academicians and what they say, is really, really a safe withdrawal rate, like, really low risk of running out of money. They actually talk about 3.2%. 4% is already considered a bit high risk by some of them. 6% is like crazy high. So being 100% in stocks and taking out 6% per year is a very bad idea. You're very likely to run into a problem where the market drops and you keep taking out money and you just go and deplete all your money. Now, of course, there's an alternative, which is if the market falls, you proportionally reduce your withdrawals. If you can reduce your expenses, then you can do that. But it's difficult, of course, to suddenly reduce your expenses so much. Could you go over how much we should keep in each brokerage before we diversify? It's not one of those cases where like you need 10 brokerages if you have a lot of money just to have a little bit in each. Because brokerages here in Europe, if you have a reputable, stable brokerage, like good, solid brokerage, it's very safe. Even if it does go bankrupt, your money is almost definitely safe. Almost. There's always that small risk of like fraud or issues, right? I would say like if you have a few tens of thousands of euros in a broker, that's when I would start looking at a second broker. At the point where you have a few hundreds of thousands, maybe three brokers. I wouldn't want to go much beyond this because it just gets more of a hassle to manage the portfolio across all these different brokerages. Sakura was asking, how can I stay motivated passive investing? There's a few different things that I do for motivation. One thing that I always used to do is use my net worth tracking spreadsheet where I kind of take note of like how much I'm saving and what my savings are worth, even though when the market goes down, that you have to be careful with the psychology. Another thing is, maybe like you have some kind of reminder once a month to maybe listen to either the Rational Reminder podcast, which I mentioned, which always inspires me for passive investing. Listen to my YouTube channel periodically. Come to these monthly updates to kind of hang out and chat with the other investors as well. Of course, if you can find some friends who are also interested in it, that can be helpful as well. If you enjoyed that, and if you want to ask me all your questions too, I invite you to join the Index Masterclass, my training program for European investors. Whether you're a complete beginner or you already have some ETFs and index funds and you want to make sure that there are no important gaps in your knowledge, I will take you step by step through everything that you need to know. So click the first link in the description and find out more.